Welcome to Section B of the Payroll Accounting course, where we focus on payroll practices specific to the United Arab Emirates. In this section, we'll cover the regulatory framework, including the wage protection system, gratuity obligations, and common deductions. We'll also review documentation requirements and demonstrate how payroll entries are recorded in the books. By the end, you will not only understand compliance requirements, but also be able to map them into accounting journal entries that reflect UAE payroll practices. In the UAE, payroll accounting is governed by federal labor law and corporate tax law requirements. Employers must process salaries through the wage protection system, pay statutory end-of-service gratuity, and keep accurate payroll records. From an accounting perspective, the monthly payroll entry typically records debit, salaries expense, and credit, wages payable. When salaries are paid through the WPS, the liability is settled, debit wages payable, credit bank. These simple but consistent journal entries ensure compliance and support future audits. The Wage Protection System, or WPS, is an electronic salary transfer system overseen by MOHRE and the UAE Central Bank. Employers prepare and submit a WPS file listing salaries, which the bank processes. From an accounting perspective, once the bank transfers salaries, the entry is debit wages payable credit bank. If salaries are delayed or WPS is bypassed, employers face penalties such as work permit suspension or company blacklisting. For example, a retail company with 50 employees must upload its WPS file monthly. Failure to do so may result in immediate fines of several thousands dirhams. End-of-service gratuity is a stationary benefit in the UAE. Employees who complete at least 1 year of service are entitled to a lump sum payment based on their basic salary. The formula grants 21 days of basic wage per year for the first 5 years and 30 days thereafter. For example, if an employee with a basic salary of 10,000 dirhams resigns after 7 years, gratuity is calculated as 21 times 5 years plus 30 times 2 years equals 165 days of salary, or roughly 55,000 dirhams. From an accounting perspective, gratuity provisions are accrued annually. Debit staff cost expense, credit provision for gratuity. When paid, the provision is settled against cash. The UAE does not levy personal income tax, but payroll still includes deductions and benefits. UAE nationals contribute to the General Pension and Social Security Authority, typically with both employer and employee contributions. Other deductions may include insurance premiums, salary advances, or adjustments for unpaid leave. For example, if an employee receives an advance of 5,000 dirhams, the entry is debit salary advance, receivable, credit bank. When deducted from payroll, the adjustment is debit salaries payable, credit salary advance. At termination, the final settlement must reconcile unpaid salary, unused leave, and gratuity. Payroll audits in the UAE often involve checking employment contracts, monthly pay slips, WPS transfers, and end-of-service settlements. These records must be kept for at least 2 years, though best practice is longer. Many companies now rely on HRMS systems to automate payroll records. For example, if MOHRE requests proof of July 2024 salaries for a company's 80 employees, the employer must provide the WPS file and bank transfer confirmations. From an accounting angle, auditors will match payroll entries against WPS and contract obligations, so consistency is essential.